external sector deals with export and import of goods and services and financial capital between two countries. Balance of payment (BOP) is an important part of the external sector. Balance of payment is a financial statement that summarizes an economy's transactions with the rest of the world for a specific time period. Balance of payment systematically records all transactions in an economy in the form of double entry bookkeeping, with the entries credited as inflows and outflows. Current account and capital account are two important parts of balance of payment. Current account is a single time and one-way transactions. Current account consists of revenue receipts and revenue expenditures of the government, whereas capital account shows net change in physical or financial assets of the nation and includes foreign direct investment, portfolio and other investments. Current account deals with export, import, invisibles, services, incomes and transfers. Export receipts are the receipts against export of merchandise goods, not services to other countries. Imports payments for merchandise is included under import. Invisibles include services, income and transfer receipts and payments across countries contributing to invisible trade. Services, export and import of services like travel, transportation, insurance contribute to services. Trade balance, the difference between export receipts and import payments is called trade balance. A trade balance can be favorable when exports is greater than imports and unfavorable when imports is greater than exports. Capital account shows the net change in physical or financial assets of a nation and includes foreign direct investment, portfolio and other investments. Foreign direct investment made by a foreign company through mode other than the stock exchange is called foreign direct investment. There are two routes for foreign direct investment in India. Automatic route. By this route, FDI is allowed without prior approval by Government or Reserve Bank of India. Government route is prior approval by the government is needed for this route. Portfolio investments made through stock exchange or secondary market, where various financial instruments like shares, debentures of a company or investor is called portfolio investment. Three major types of portfolio investment are foreign institutional investment, depository receipts, and offshore funds. Foreign portfolio investors can be foreign institutional investors, qualified foreign investors, and sub-accounts. Thus, current accounts include three components: trade in goods, trade in services, and transfer payments. Trade in goods deals with export of goods and import of goods. Trade in services can be net factor income and net non-factor income. Trade in services includes net factor income and net non-factor income. Net factor income is net income from compensation of employees and net investment income. Net non-factor income is received from shipping, banking, insurance, tourism, software services. Transfer payments consist of gifts, remittances, and grants. The components of capital account include investment, external borrowings, and external assistance. Investment can be direct investment or portfolio investment. External borrowings can be external commercial borrowings, short-term debts. External assistance can be government aid, intergovernmental, multilateral, and bilateral loans. External commercial borrowings can be loans in the form of buyer's credit, bank loans, supplier's credit. It also includes commercial borrowings from multilateral financial institutions like International Financial Corporation, Asian Development Bank. Other items of capital accounts includes external assistance, external commercial borrowings and trade. Current account deficit measurement for countries trade when the value of goods and services it imports exceeds the value of goods and services it exports is called current account deficit. Effects of current account deficit on Indian economy. Current account deficit is financed through borrowing, which may be proved to be unsustainable in the long run. When current account deficit is financed by attracting foreign capital flows, it puts the domestic economy at certain risk from external factors like sudden withdrawal of investment. High current account deficit may create low confidence by foreign investors. However, a current account deficit is not necessarily harmful because it implies an excess of investment over savings. Current account deficit can lead to a highly productive and growing economy. If the deficit reflects low savings rather than high investment, it could be caused by reckless fiscal policy or excess consumption. Currency convertibility is the ease with which the country's currency can be converted into another currency or gold. Convertibility is extremely important for international commerce. When the currency is not convertible, it poses a risk and barrier to trade with foreigners who have no need for the domestic currency. Current account convertibility allows free inflows and outflows for all purposes other than for capital purposes such as investments and loans. It allows residents to make and receive trade-related payments for export of goods and services and pay for import of goods and services, studying abroad, medical treatment and gifts. Current account is fully convertible in India as per IMF conditions. However, capital account convertibility is not fully allowed in India. It is the freedom to convert local financial assets into foreign financial assets and vice versa at market determined rates of interest. Though India has partial convertibility in capital account, enough reforms have to be made to allow full capital account convertibility. Tarapur Committee on Capital Account Convertibility recommendations came in 2006. The committee's view was that fuller convertibility is required to get foreign funds for huge investment needs of the economy. The specific recommendations of Tarapur Committee on Capital Account Convertibility were: the report recommended future implementation of full capital account convertibility in three phases spread over 5 years. The report sought a ban on participatory notes as a mode of investment in Indian equities and easing the direct investment routes for foreigners. It suggested that foreign individual investors should be treated at par with non-resident Indian investors. The Tarapur Committee recommended the restrictions on overseas borrowings by Indian firms and banks be reduced. It recommended the limit on dividends by individuals be increased. But before making the rupee fully tradable, financial and banking standards and regulations must be in order. The fiscal deficit must be brought under control. Otherwise, a large fiscal deficit will make India's economy vulnerable to shocks. Foreign exchange reserves are reserve assets held by RBI in foreign currencies used to back liabilities on their own issued currency as well as to influence monetary policy. The forex of India is held by the Reserve Bank in form of foreign currency assets, gold reserves, and total special drawing rights of IMF. The exchange rate regime is a system in which a country's monetary authority, usually the central bank, adopts to establish the exchange rate of its own currency against other currencies. Fixed currency regime is a country's official exchange rate tied to another country's currency or the price of gold by the government. Floating currency regime: the currency price is based on supply and demand compared with other currencies. The domestic currency is decided based on the market demand and supply. Floating currency can be a managed float or a free float or a dirty float. The domestic currency is left free to float against the number of foreign currencies in its foreign exchange market and determine its own value. It's called market-driven exchange rate. Managed exchange rates is a hybrid of fixed and floating exchange rate system in which the central bank attempts to affect the exchange rate directly or indirectly by buying or selling foreign currencies and through monetary policy, respectively.